Hello, and welcome back to my channel. My name is Elaine, and if you're new here, I am a business coach and I help you either start your new business or grow your existing one. And we talk everything business and entrepreneurship. So today I'm going to break down EBITDA. Now, what I try to do is try to break down business concepts in the simplest way possible so that you get an understanding of what it is and how it can help your business. Now, I know EBITDA sounds like a mouthful, but by the end of this video, you will understand what EBITDA is and why it matters for your business, even if you are just starting out and a new entrepreneur, or if you're a seasoned entrepreneur and you're just trying to figure out how to get your business straight. So, what exactly is EBITDA? EBITDA is a financial term and it stands for earnings before interest, taxes, depreciation, and amortization. Now, let's break that down into simple terms. Earnings. So, earnings is just another word for profit. It's the money a company makes after covering all of its basic expenses. Before. Before means that we're looking at earnings before we subtract certain expenses. Interest. Interest, this is the cost of borrowing money. If a company takes out loans, it pays interest on those loans. Taxes. There are certain amounts to be paid to the government either quarterly or yearly, however you do your taxes. Just like how we pay taxes as individuals, companies also pay taxes. Depreciation. This represents the reduction in value of a company's assets over time. So, when we talk about depreciation, this represents the reduction in value of the company's assets over time. Think of it like the wear and tear on your car or on your computer. When you go to turn that car back in, usually you get less than what you originally paid for it. And amortization. This is similar to depreciation, but for intangible assets like patents or trademarks. It's the spreading out of the expenses of that asset over time. So when we talk about EBITDA, we're looking at a company's profit before we take out these specific costs. It's a way to get a clearer picture of how a company is performing operationally without the impact of these financial and accounting decisions. Now that we know what EBITDA stands for, let's talk about why it's so important. First, EBITDA is a great measure of a company's overall financial performance. It focuses on the core profitability of the business by stripping away the effects of financing, accounting decisions, and tax environments. It gives us a clearer view of how the company is doing in its day-to-day operations. Second, EBITDA is incredibly useful when comparing companies within the same industry, since it excludes interest, taxes, depreciation, and amortization. It levels the playing field. This way, you can see which companies are truly more efficient and profitable without the noise of different tax rates, financing structures, and accounting policies. Finally, EBITDA helps us understand a company's operational profitability. It shows us the profit generated from the core business activities, excluding the costs related to debt and non-cash expenses. This can be particularly helpful for investors and analysts who want to assess the company's true operational performance and profit for potential growth. So, in summary, EBITDA is a key metric for getting a clearer picture of a company's financial health and making more informed comparisons and decisions. All right, now let's get into how to actually calculate EBITDA. It's pretty straightforward once you know the formula, so do not be scared. EBITDA equals net income plus interest plus taxes plus depreciation plus amortization. Let's walk through a basic example to make this clear. Imagine a company has the following financial figures for the year. They have a net income of $50,000. They have an interest expense of $5,000. Their taxes are $10,000. Their depreciation is $8,000 and their amortization is $2,000. We start with the net income, which is the profit after all of the expenses have been deducted. In this case, it's $50,000. Next, we add back the interest expenses, which are $5,000. This gives us $55,000. Then we add the taxes, which are $10,000. This gives us $65,000. After that, we add depreciation, which is $8,000. This brings us to $73,000. Finally, we add the amortization, which is $2,000. This gives us a total of $75,000. So the EBITDA for this company is $75,000. You see, it's not so complicated when you break it down like this step by step. This is a very powerful tool for evaluating a company's performance without getting bogged down in the details of financing and accounting decisions. Now, let's look at a real world example. I'm going to give you a fictional company called Tech Gadgets Incorporated. And here are their financial figures for the year. So they have a net income of $100,000, interest expense of $15,000, taxes of $20,000, depreciation of $12,000, and amortization of $3,000. You can pause this video really quick to see if you can figure out what their EBITDA is. Okay, we're back. Let's see if you got it right. So we will start with their net income, which is $100,000. And then we will add back the interest expense, which are $15,000. And then we have to add back the taxes, which are $20,000. And then we have to add back the depreciation, which is $12,000. And finally, we are going to add back the amortization, which is $3,000. So the EBITDA for Tech Gadgets Incorporated is $150,000. Did you get that correct? By following these steps, you can calculate EBITDA for a company to gain a deeper insight into its operational performance. This is especially useful for companies in the same industry or evaluating potential investments. Remember, EBITDA gives you a snapshot of the company's profitability before accounting for finances and accounting choices. It's a powerful tool to have in your financial toolkit. While EBITDA is a very powerful metric, there are some limitations. EBITDA may not be able to give you the full picture of a company's financial health. Here are a few reasons why. The first one is because of capital expenditures. EBITDA does not account for capital expenditures, which are the funds a company uses to buy, upgrade, and maintain physical assets like buildings, technology, or equipment. These costs can be significant and impact the company's cash flow and financial stability. The second one is changes in working capital. EBITDA ignores changes in working capital, which include accounts receivable, accounts payable, and inventory levels. These changes can affect the company's cash flow and operational efficiency. Another one is debt and interest payments. Since EBITDA excludes interest expenses, it can make highly leveraged companies, those with a lot of debt, look more profitable than they actually are. This can be misleading, especially if the company has significant interest obligations. The next is tax considerations. EBITDA also ignores taxes, which can vary widely between companies due to different tax rates and structures. This can make it difficult to compare companies across different regions or sectors. Like your tax in New York could be completely different than your tax in California. So finally, EBITDA excludes several key expenses. It can be used to paint an overly rosy picture of the company's profitability. This is why it's important to use EBITDA alongside other financial metrics for a more comprehensive analysis. In summary, while EBITDA is a very valuable tool for understanding operational profitability, it should not be used in isolation. Always consider other financial metrics and the broader context to make informed decisions. By being aware of these limitations, you can use EBITDA more efficiently and avoid common pitfalls in financial analysis. Remember, no single metric tells the whole story of a company. Okay, let's recap what we've covered today. We broke down what EBITDA stands for, earnings before interest, taxes, depreciation, and amortization, and explained each component in very simple terms. We discussed why EBITDA is important, how to calculate it with a clear example, and some of its limitations. If you have any questions or if there's a topic that you would like for me to cover in a future video, please leave a comment below. I would love to hear from you. And if you found this video helpful, don't forget to hit the like button and subscribe to the channel. And share this with all of your friends who are nerdy business people like us. Your support helps me make way more content like this, and I just love sharing this with you guys. So, thank you so much for watching, and until next time, stay curious.